Good afternoon from Oxford. Welcome to our conference to launch our latest white paper with value partners. This is the second in a series entitled Investing in China, Riding the Dragon. Now, before I go into the agenda for this meeting, I would like to introduce my colleagues who will be participating in the conference, and I would like to make some preliminary comments thereafter. So if I could start with the introductions. With me here in Oxford is Joe Knight, Principal at Oxford Metrica. In Hong Kong, we have the Senior Value Partners team. We have President Dr. King Ao. We've got Co-CIO Renee Hung, and we've got Senior Portfolio Manager Frank Choi. Welcome. Evidently, the pandemic has had a very disruptive effect on financial markets. We have done our best in this study to deal with that uncertainty, but we have not allowed it to distract us from our prime purpose, which is to seek emergent opportunities as they arise in China. And in the words of the investment legend Sir John Templeton, trouble is very often opportunity. Our attitude in this paper has been to proceed from a position of optimism with respect to China. If one considers the larger picture with respect to China, here is an economy that adds an additional UK economy every 4 years or so. By 2027, it will be the largest economy in the world. And if one considers the recent announcement by the People's Bank of China, it means that we have what is about to become the largest economy in the world, which is owned 93.7% by local people. It is quite obvious that there will be an equilibration whereby the take-up by foreign investors will provide, we believe, a long-term support to the opportunities in China. We have in this study identified 3 key factors that signal that China is going to emerge first and strong from the current crisis. The first is the share price resilience. You will be hearing today about the way in which the Chinese markets have held up much better than other markets. The second factor is the management of the virus itself. China's done a very good job of that, and they are certainly beyond the first major peak of infections and have come out of it with a very low case fatality rate, which is extremely positive for all of us. The third factor we report is the uptake of business production. China is really largely back at work, and it's quite remarkable the way in which they've been able to come out of that. We have discerned a 3-pronged approach being taken by the policy planners in China. They are monetary action, fiscal steps, and industrial policy actions. With respect to monetary, we have the People's Bank of China with an extremely large and robust balance sheet, operating in a market with relatively high interest rates, which means that their monetary execution will be much more impactful than, say, the Federal Reserve. So they have a greater capacity to make these interventions. On the fiscal side, you'll see us detail many ways in which the Chinese government is able to reach where no other bears can reach, if you see what I mean, and have impacts with tax changes, etc., in very specific areas. Third, on industrial policy, being a centrally controlled economy, they have the opportunity to mobilize resources to where it's needed most. That is typically in infrastructure and technology. Clearly, these actions and policies are what will inform the sorts of topics that we will be discussing today. But the premise of the paper is that China is more opportunity than threat for the international investor. If I may now turn to the agenda that we have for the talk today, the conference. We hope that you will be able to submit questions, so we'll certainly be leaving time for that. We will begin with here in Oxford giving us an overview of market performance. We will then move across to our colleagues in Hong Kong, where they will deal with the myths of investing in China, dispelling them, and dealing with the investment themes that we have identified in the paper. We will then close the conference with a set of questions that we hope that you, the participants, will be sending through on the chat line. So I do want to thank you again for taking your time to participate with us. We will be making this material available immediately after the session, and we'd be quite happy to continue the dialogue thereafter. Joe, could I invite you to take up the market performance section, please?
Certainly. As the release of the white paper coincided with us entering a new decade, we thought it was important to firstly look back and analyse the performance of the Chinese equity market over the last 10 years. Slide 1 shows the performance between the end of 2009 and the end of 2019 of the two onshore exchanges, Shanghai and Shenzhen, and the offshore Hong Kong market. As is evident from the slide, there have been periods of over and underperformance across the decade, with the boom and bust of 2014-15, as well as the volatility seen in 2018 due to the protests in Hong Kong and the trade tensions between the United States and China. Over that period, the Shenzhen market was the star performer, generating over 40% in US dollar terms across the interval. Hong Kong generated 28%, whereas the Shanghai market actually lost just over 8% across the decade. However, as we closed the decade, there was cause for optimism, as all three exchanges did have positive 2019s. However, with the onset of coronavirus and subsequent pandemic, global equity markets endured a terrible time. However, China has been largely robust to this down performance. When looking at the MSCI China index in US dollar terms over the first quarter of this year, it actually ranked second in terms of global equity market performance. Slide 2 provides more granularity on the Chinese equity market performance. As you can see from slide 2, the Shenzhen market is actually in positive territory up until the end of April of this year. The Shanghai market is down around 7.5% and the Hong Kong market down 12%. However, in the global context of market performance, this is reasonably robust. The second half of our analysis in the white paper also wanted to consider the risk considerations when approaching Chinese equity markets and how an international investor might best decide to whether to invest in China via an emerging market mandate or directly into the Chinese markets. Slide 3 shows the efficient frontier that was generated when optimizing between three major Chinese exchanges, the MSCI BRIC Index and the MSCI Emerging Market Index. The key finding here is that with the tangency portfolio, with the higher Sharpe ratio, as well as the minimum variance portfolio, both have a high allocation to direct Chinese equities. The tangency portfolio allocates over 88% to the Shenzhen market, and the minimum variance portfolio allocates 45% to a mix of Hong Kong and Shanghai, really pointing to the fact that access to the Chinese markets is vitally important for an international investor. Thank you.
Good, thank you, Joe. We'll now move on to Hong Kong and hand over to King for the next section of the conference. Thank you, King.
Good morning, everyone. Further to Rory and Joe's introduction, I would like to emphasize that we are having the investment opportunity of a lifetime, with China being the second largest economy, opening up the domestic market to global investors. I understand some of you may have certain concerns about China's economy and market structure, but with our 70-strong investment team covering the Greater China region on the ground for 27 years, we at Value Partners do have insights to share with you all. On this note, I would like to introduce my colleagues, Frank, to dispel some of the myths about China, and Renee to share our investment ideas. We'll be more than happy to answer your questions at the end of our presentations. So please send in your questions using the Q&A button on the bottom of the screen. So over to you, Frank.
Thank you, Kate. Good morning, everyone. Really appreciate your time to dial in to this conference or webinar. I think before we actually go into the investment themes that Renee will be discussing with all of you, I would just like to cover 5 myths that the white paper actually has been the key topics that people have been talking about China investment. When we're looking at the first myth, the slowing growth is narrowing the opportunity in China. Just to begin with, I think it is inevitable to see a declining growth rate in China as China has become the second largest economy in the world. When we are looking into some absolute number, for instance, from 2005 to 2019, the GDP in dollar term, we're looking at 18 trillion RMB, growing 5.5 times to 99 trillion RMB in just 14 years of time. So looking at 6.1% growth on a 99 trillion RMB economy, it's still a massive number. And secondly, I think it is actually interesting to see the breakdown of the contributions of GDP by different sector, and there's a lot more to tell. Where there you could, a lot of the investor would be able to find exciting growth story. In the last 3 decades, China actually has transitioned into from a very old economy-driven economy back in early 80s to 90s, as a primary sector-driven economy, into a more secondary sector-driven economy after China joined WTO, as a lot of the manufacturer exporters were actually benefiting from the economic growth. And lately, we're actually into a more tertiary sector-driven economic growth structure. As you can see from the bottom left-hand side of this chart, we're seeing the tertiary sectors are driving almost about 54% of the GDP growth in China, and that has been represented by services and consumption-related sectors. And also, looking at the bottom right-hand side of the chart, China consumption growth is looking at around 58% versus US 68% as a developed market. By saying this is, we're actually looking, the transition of the growth structural change in China, and investors, if they're able to identify the growth transition or the structure of the growth engines, we're still looking into a lot of exciting growth numbers, breaking it down to different sectors, such as the chart that I'm showcasing in the next slide. This is the 2021 expected earnings per share growth. Despite the energy being the top EPS growth sector because of the lower base in 2020, there has been a very consistent contributions or growth drivers coming from the tertiary sectors such as consumer discretionary, information technology, communication services. With that said, we're actually still looking at 20 to 30% growth despite the earnings downgrade pressures still persist. This has been a consistent image about how China sectors are driving the MSCI China index growth from an earnings per share growth perspective. So this is the first thing. For the second myth, the Sino trade tensions will dampen innovation. Just to begin with this topic, I would like to share this chart, which showcases how the global supply chain really in place in terms of how different countries are playing their role under the globalization. South Korea, for instance, they are the biggest chipset in memory chipset manufacturer in the world, while in Taiwan is the #1 ranked in terms of integrated circuit manufacturer, while in the US, they are the #1 ranked IC designers in the world. You can see this whole globalization, they're interlinked with each other with a complicated relationship. Just looking at China, to a certain extent, I could agree the myth about the kind of like restricting their access to specific technology components will be a big issue for China. If you're looking at this chart, China actually consumes over 58% of the integrated circuit consumption of the world, and they're the largest, while they're actually having about 14% of this integrated circuit consumption that are domestically supplied, which means they're actually having a very low self-sufficiency rate. So back in 2018, this is a big issue for China. However, when we are looking into how China has responded, they are actually speeding up the process of localization of the supply chain starting from 2014, but this is actually speeding up in 2017 and 18, and even after the Sino trade tension has gone up. This is the big fund set up to foster the domestic localization of supply chain. What that means is, for every $1 commitment in the big fund, the local government will be subsidizing $3 of funding to help these corporates to set up respective component supply chain productions. These $3 could be coming in different form, not necessarily just in dollar cash term. It could be in a tax benefit kind of form, and also giving benefits such as lower rental on the land supply to these different manufacturers. So this is highly supportive by the Chinese government to speed up the localization. I would just still have to say it would take time for these localizations to happen, because technology supply chain is not something that you can make in one day. China is still lagging behind in terms of some of the very advanced technology component manufacturing, but it is speeding up. So going back to the myth about the Sino trade tension will dampen the innovations, I think instead of seeing the damage, I'm actually seeing the speed up of the innovation in China as they are pursuing the localization of the supply chain manufacturing process. So this is the second myth. Going into the third myth, which is the market restrictions limit investment returns and liquidity. I think this is echoing what Joe has mentioned about the China market performance, which could address this myth. However, looking from a different angle, China is under a very big kind of underrepresentations in the global emerging market index, as well as other major indices under MSCI China and FTSE, that the second largest economy in the world is only taking up 4% of the MSCI emerging market index. From this perspective, the MSCI China Asia's inclusion, which was announced in 2017, has a big role to play. The inclusion factor will be a multi-year process to have a full inclusion of China Asia's, and we're expecting about 10 years' time to have a complete full inclusion. However, when you're looking at the bottom half of this chart, starting from 2018 to 2019, it has attracted almost about 790 billion RMB flow into the China Asia's market by both passive and active manager. As this Asia inclusions continues, we expect there will be a continued steady flow in the amount of around 27 billion per annum for the next 6 to 7 years of time. So we actually believe this steady flow will continue to improve the return and the liquidity profile of China Asia's. But not only that, I think the MSCI Asia inclusion actually carries a very crucial symbolic value, that it increased the awareness of the China Asia's market to international investors. And the fourth myth that I would like just to quickly highlight is idiosyncratic investor behavior in China hinders investment. I think this is, to a certain extent, is correct, that China Asia's market is a very different or separate market versus even the offshore China market or ADRs, simply because of the investor structure in China onshore Asia's market. Currently, the retail investor in China still takes up the majority of the daily turnover percentage, with over 80% coming from the retail investor. These investors are trading driven, very short term. I'll probably just say they are also very ambitious on returns, so they're very news flow driven as well. And the second part of the investor structure is the increasing international investor involvement in the Asia market, thanks to the MSCI Asia's inclusion. However, a lot of the international institutional investor, perhaps this is just their first time getting into the market. They are ramping up their coverage in the market, and based on the flow that we have seen in the last few years' time, they are very concentrated in the index large cap or blue chips company in China, Asia's market. And this kind of investor structure actually create what we call a market inefficiency, and that gives some certain level of opportunity for active manager to deliver alpha. Looking at this chart in here, I have listed out the active manager performance versus CSI 300 index, which is an onshore Asia market index, which many people would reference to. In a different period of time, active manager, unlike the Western country or the developed market, they are actually able to deliver excess return. And we believe the diluting of the retail investor because of increasing international investor involvement will continue to evolve this market to become more fundamental driven, and active manager will be rewarded based on the change of this investor structure over time. And lastly, it's about the last myth, as the Chinese companies ignore non-financial dimensions. I think this is probably coming into a more ESG-related perspective about how Chinese companies have been evolving over time. In the last 24 months' time, I think it is actually very interesting about how the awareness of ESG-related matters has increased, not only on the corporate listed company level side, but also for buy-side managers or asset owner within the Asia region. And China in particular, this chart has showcased an increasing number of Shanghai and Shenzhen listed companies that they are willing to increase their reporting with the engagement and related ESG initiatives to the public. I think this is a growing trend that we're seeing very strong momentum. And as an asset manager, Value Partner has also become the UNPRI signatories last year. And we're actually seeing a lot more companies that have disclosed and really actively providing their pipelines and their plans on ESG related matters. I would still like to say we're in Asia or in China, we are still at a very early stage for ESG developments, but definitely we're seeing a very strong momentum, in terms of the awareness and also the engagement by the listed companies in China. So this is the conclusion of the 5 myths, and perhaps I'll probably just pass over to our Deputy CIO, Renee, to talk about our investment themes within the China market.
Thank you, Frank. Good morning. It's my pleasure to present to you our top investment themes in China. And as Frank pointed out, consumption is going to play a very important part continuously in China. I would like to start talking about the consumption upgrade story. It is estimated that out of the 1.4 billion population in China, middle class population accounts for 400 million, or it means 140 million households. There are many definitions for middle class, but we loosely define those who can afford a flat, a car, and leisure travel, and earns about 10,000 to maybe 35,000 US dollars a year. the increase in number of middle-class population and the increase in middle-class income are the key drivers to the demand for better quality goods and lifestyles. As shown in the few examples in this slide, we also notice larger companies continue to become larger, as they have the scale to innovate and being able to gain market share by launching premium products to cater to the needs of the growing demand in the middle class. This slide shows a survey done by McKinsey, basically reinforcing the consumption upgrade patterns has started, and we expect this to continue. Post-virus, we have also seen consumers become more health conscious, further driving the demand for high-quality consumer brands. Aside from the quality of the goods itself, the intangible aspect is also important to consumers nowadays in China. We are seeing increasing demand for services such as gym, traveling, and even services related to pets. The next theme would be healthcare. Healthcare spending in China has plenty room for growth. Currently, healthcare spending as a percentage of GDP is only 5% compared to 18% in the US. Aging population and growing disease incidence rate will bring this number in China to increase. We mainly invest in innovative drug maker and biotech companies because of their drugs are not subject to centralized procurement tender, meaning they are not commodity drugs that are subject to steep yearly price cut in China. In this table, we listed out some companies that have a strong pipeline of new drugs and are either launched or already in advanced stage of clinical trial. We expect these companies will gain market share from the current imported drug market in China with more competitive pricing, and thus can enjoy sustainable earnings growth. As you can see, China's average tuition fee for private universities are significantly lower than many other countries. It is currently still below $2,000 per student per year. So in order to cope with the increasing requirements, we have seen steady increase in tuition fee in China, about 3 to 5% per annum in the past few years. This rate of tuition increase actually has been more than enough to cover the cost of increase. Every year, there are more than 9.5 million students taking the university entrance exam in China, as you can see from the lower table. However, there are only 4 million bachelor degrees and 3.5 million diploma degrees available per annum. So we do see a insufficient supply of higher education. This slide shows the China market from an enrollment ratio perspective. Out of the total 16 million population that are eligible for the university entrance exam, we estimate enrollment ratio is only at 48% versus over 80% enrollment rate for more developed countries. For example, the ratio in US and Canada exceeds 80%. It is the government's intention to increase China's enrollment ratio. As in many countries globally, online consumption demand is growing rapidly. In China, not only we are seeing strong demand for physical goods via e-commerce platform, we are also seeing huge potential for online service platforms. In e-commerce, monetization rate is an important measurement of revenue generated from the platform. Monetization rate is the fee ratio charged by the platform provider to these vendors, similar to the concept of commission fee and advertising fee. Judging from the experience we have seen from the physical goods from the e-commerce platform, we estimate the monetization rate for online service platform can grow by 6 times in the years to come. In this slide, we list out the percentage of sales via online platform as a percentage of the total market size in China. As you can see, about half of the electronics are already sold online. Apparel, maybe about 43%, versus only 11% of beauty services are booked online. Food catering is even lower at only 3%. We estimate online booking service market will grow over 30% annually in the coming years. Despite China was encountering very steep fight against the COVID-19, the Chinese government has reiterated many times that they are focusing on the development of 5G. We expect 5G is going to open up a lot of growth avenues in many aspects that 4G couldn't due to its bandwidth applications. We see industrial use will increase, such as in smart cities, cloud computing, AR, VR, and even autonomous driving. The number of connected devices are expected to increase more than double by 2025, from 9.1 million units to more than 25 million units, driving the big demand growth for Internet of Things devices. With that said, except smartphone, other 5G related sectors are expecting double digits CAGR growth till 2023 and beyond. The near-term pause on global demand due to the lockdown may have some short-term impact. However, outlook in medium to long term remains solid as global economy activities resumed. Anyhow, the near-term demand is not all pessimistic. Due to more activities, work from home, demand for notebook, cloud services have been increasing, much better than previous expectations. And here concludes my part of the presentation, and I will hand over back to Rory.
Great, thank you very much, Renee, and colleagues in Hong Kong, King and Frank. Excellent presentation. Colleagues on the call, you will see that we covered a large amount of information and data and ideas, all of which is laid out in the white paper which you will be receiving. I'm conscious of your time, but I would not like to lose the opportunity to pose some of the questions that I've received from the participants. Perhaps we could fit in a couple of these. I think they're excellent. If I could pose the question then, how will potential deglobalization affect the internationalization of the RMB? And how do you see this trend impacting China's future economic and strategic position in the world?
Sure. Maybe I could just quickly answer these questions. I think, yeah, there has been a bit of pressures in terms of deglobalizing, the world. I think first of all, RMB, when it comes to a balance sheets of China government, it actually has a little bit of indications on RMB could become a stronger currency with a higher demand. Looking on how the central banks around the world actually has implemented policy easing in the last 6 months' time. The central banks in the Western countries, including European central banks and also the Fed in the US, we're actually seeing a continued interest rate cut, and that kind of real negative view in the European markets is giving a very big divergence between the interest rate differential between China and European market as well as in the US. And I think that spread will actually give a bit more attractiveness for RMB just as a currency. This first thing. Second thing is about the demand for RMB from a capital and bond market perspective. As mentioned earlier, we are actually looking at the MSCI Asia inclusions to continue for the next couple of years of time at least. And also we're actually looking at the onshore bond market opening to the global. And just in March, we have actually witnessed about $10 billion bond purchase on the onshore Asia market. And that has been causing quite a bit of flow into the market that is dominated in RMB. So I think also on from a fiscal balance sheet perspective, China actually will actually still seeing the fiscal deficit standing at around 3.5% and actually having a relatively healthier balance sheet versus other countries, not only in Asia but also in Western countries. So that gives a little bit more strength and foundations for RMB to continue to remain the strength. However, I think in terms of the deglobalization, I think this is actually an interesting kind of like questions about how we're actually looking forward up till November before the U.S. elections, because obviously the last couple of days of time we have started to see the restrictions on Chinese investment. Actually the tensions between U.S. and China has come back again, and I think in the near term that will pose a certain level of uncertainties and volatilities in the market. However, just going back to the questions about internationalization of RMB, the market is still opening up, and I think this is still continue to be the trend in the next couple of years of time.
Great, thank you, Frank. There are 2 or 3 participants. Some questions. My apologies to paraphrasing. This question, the consolidated question, revolves around recent pronouncements by the US president to stop federal pension funds from investing in Chinese equities. I imagine there would be significant ramifications from that. What are your thoughts on that, either the likelihood or what would the impact be if it actually came about?
Sure. Maybe I could just...
Yeah, maybe I can also start because it's not the first time that we encounter this news. I remember that last year, President Trump already mentioned this potential, scenario, and then the market were excited negatively for a few days, and then they move on to other matters. So I suppose we are still in the theme of that at the end of the year, there is this presidential election. So we are expecting more of this kind of news flow here and there coming along.
Yeah. So going back to what Frank said, I think the inclusion is already set in stone. So by the end of the year, some of the bond indices, global bond, emerging market bonds will have 10% in China. And then Frank also mentioned we expect something like $30 billion inflow into Asia market, just based on index inclusion alone for the next few years. So I think the trend has already been set. It's very difficult to do a U-turn.
Yeah, I mean, I totally agree with Renee and Kane about how the U.S. is going to continue this kind of event ahead of the elections. But I think just put things into perspective about the potential impact is I think ADR will be a little bit more affected because of higher dominance, which the U.S. domiciled investor actually takes up 40% of the ADR versus about 17% in the offshore China equities market. So from that perspective, I think the ADR market will be more kind of affected. But I think going back to what Renee has gone through about the investment themes, about all this deglobalization, I think this is actually a very good kind of opportunity to focus on domestic driven sectors in China, such as China education, e-commerce, that are more immune from this kind of like macro and political event risk. So that's why I think we're still focusing on pretty much about all these investment things.
Yeah, just brought up another important point. China is probably going to be the biggest consumption market in the world. So can that be ignored?
Yeah, that's a very interesting perspective that you've brought to that. If I could just add a little bit, I made reference to the POBC's balance sheet. We'd have to remind ourselves, and I'm sure everyone involved in this has a very good understanding of game theory, but it certainly there would be consequences on the other side. We've got to remind ourselves that the Chinese are collectively the largest holders of US government securities. So we would hope that a decent compromise and path might be found. So thank you we went on to slightly broader territory there, and I'm very pleased that we've got a number of our US colleagues asking us those questions, and we really do appreciate the dialogue. Joe, I've got another question that may be in your camp, which is you referred to the US dollar performance of the various markets over the decade. The question is, to what extent was currency a driver of those returns from a US perspective?
Over the period, I guess it was actually very minimal. The currency contribution was around 0.4, 0.5% to the returns. So the currency risk was very low across the decade. And a lot of the vast majority was domestic market performance.
Thank you. Good. Well, we have had a very productive session. I'm glad we could field those questions. With the last one, we managed to incorporate 3 or 4 participants' requirements. I'm very conscious of your time, and both our speakers and for our good colleagues who chose to join the call. We will be making this material available, both the white paper and a recording of this session. It just simply remains for me to thank my colleagues here in Oxford and in Hong Kong for their participation, and to thank you colleagues around the world for joining the call today. I wish you great success with your investing, and I do hope you enjoy the rest of your day. Thank you and goodbye.
Bye. Thank you.
Thank you.